Good morning. Eric Jefferson presenting the market observations call for the week of September the 12th. On early trading, we have stocks up about a point Monday morning, but that was following a 3.5% week rally last week. The back of some encouraging ISM or economic data. As well, we continue to see a very strong or resilient labor market. But I think the biggest headline last week driving markets is ultimately participants getting comfortable with the notion of a 75 basis point rate hike that will, in all likelihood, be announced next week. That is, of course, ahead of inflation data that we get tomorrow. As we've talked about for some time, inflation continues to be paramount. So take a moment to dissect expectations. As well, we can then talk about some positioning with respect to fixed income and to equities. So expectations for tomorrow's headline CPI figure. Again, CPI Consumer Price Index, that measures the year over year and month over month cost of a basket of goods. The expectation is for that figure to decrease from 8.5 to 8.1%. I think that expectation has also helped contribute to a rally in stocks here. However, in my opinion, the more important data point we're going to get tomorrow is on core CPI. Core CPI strips out the more volatile food and energy. That incorporates the stickier components of inflation, things like rent and healthcare. The expectation is actually for core CPI to marginally increase from 5.9 to 6.1%. Now, I think that's arguably more important just because I think that is ultimately going to be a bigger emphasis or focus of the Federal Reserve. Food and energy only makes up about 20% of that overall headline CPI figure. So when we talk about making meaningful progress, getting CPI trending back towards that 2% long-term average, obviously a healthy chunk of that is going to have to come from the core CPI segment, which has at least up to this point yet to show any meaningful progress towards reversing lower. So as we interpret the data next week, absent of some major reversal, which is not expected by anybody, really hard to see those figures change the path of the Federal Reserve. I think we are likely going to be in a higher interest rate for longer term environment. And as we then think about what that means for positioning, turning to fixed income or to bonds, don't necessarily view those as much of a headwind. Again, bond prices and interest rates move in opposite directions. Where we do think interest rates are going to go marginally higher here over the short term, do think they will eventually stabilize. The question then becomes, again, what happens from there? Do we get meaningful progress on inflation to the point where the Fed is then able to take their foot off the gas pedal? Thus far, they have come out and said they are willing to do whatever it takes. Question is then going to be, will they still stick to that thesis or that outlook, depending upon where we are with respect to economic growth and inflation trending downwards. So when we think about fixed income, again, don't necessarily view higher interest rates as much as a concern as we've seen over the certainly first 9 months of the year. That being said, although they are paying higher income today, don't know that they necessarily offer as much protection or a hedge against equity volatility. Again, historically speaking, if stocks decline, bonds tend to rally. That's the result of the Federal Reserve cutting interest rates, creating a more accommodative environment. Obviously, nobody is calling for that over the short term here. So something worth reconsidering how fixed income portfolios are positioned today as you think about the role that they ultimately play in a portfolio. Now, turning over to equities, for tactical investors, actually are very comfortable with the notion of being a little more conservative here. And that's really for two key reasons. One, we can argue that current price levels and current PE ratios are appropriate based on all of the data that we know today. However, two things to keep in mind, those ratios are considering a terminal rate of around 4%. Again, that's the figure where the Federal Reserve will ultimately stop hiking rates. If the Fed moves higher beyond that, that would likely be a headwind for both stocks and bonds, creating additional volatility. The other piece to keep in mind is current PE levels are pricing in the expectation of 8% earnings growth over the next 12 months. Virtually every single pundit, institutional research firm, or organization is calling for those estimates to likely come down a little bit. That's something as we prudently position portfolios for the environment we're in. Do think there's case to be made for taking some of those chips off the table. Additionally, when you think about the opportunity cost of having a more conservative portfolio today, again, nobody out there is really calling for a 15% rally to get us back to where we were January 1st. And so if we expect markets to be somewhat choppy in the short term, don't necessarily view, again, taking risk off the table, something that could hurt you by not participating in additional appreciation over the short term. That's all for now. As always, please let me know if you'd like to discuss anything in more detail. If you don't connect, have a great week. Take care.